Are you prepared for what's going to happen in 2026 to your tax rates? If not, if you haven't heard what's going to happen in 2026, then make sure you tune in here and make sure you focus in on what opportunities you have as you plan for these next 3 years before 2026 happens. So, when we look at our current tax rate here, this is federal income tax rates. You're going to see the 12%, the 22%, the 24%. If you're not understanding how to understand the tax code, I've actually done a video that you can click on there that you can actually get a better understanding of how this works. But what I want to point out here is that most people, based on their income, are either going to sit in the 12, 22, or 24% brackets. Their taxable income is going to put them in those brackets there. So what I want to talk about then is, hey, here is the 2023 brackets, but let's compare it to what it was in 2017. So let's pull that up here. So in 2017, you'll see at the bottom, and then the 2023 rates are just what I just went through there on the top there. So the main things we want to point out here is look at the brackets. The 12% in the 2023 is going to turn into the 15% if we look down at 2017. 22% today is going to be 25% in 2017. 24% was 28%. So you see where I'm going there? So the point I'm trying to make here is that in 2026, there's something called the Tax Cuts and Jobs Act, and that's going to expire, and then the 2017 rates are coming back. So we need to be prepared for what we're seeing at the bottom of the screen because those are going to be our new rates here soon. And so in 2017, that Tax Cuts and Jobs Act lowered taxes until 2026. So we currently have lower tax rates today than we are going to in 3 years. And so the main points I want to point out here is if you're in the 12% bracket today, you're going to be in the 15, as I just mentioned. So obviously I'll ask a really hard question. Would you rather pay 12% or would you rather pay 15%? Would you rather pay 22 or would you rather pay 25? Would you rather pay 24 or would you rather pay 28? Right? This isn't that hard of an answer, right? So what we have to decide then is what is our taxable income going to be today and what's it going to be in the future? And there's obviously a lot of other decisions that have to be made there, such as what's your Social Security going to be, what is your RMDs going to be, your required minimum distributions, which we have other videos on that as well. And so we really need to make sure we're aware of how all of this stuff plays together. So that's the one big difference in 2026. When tax rates change, that's going to be one of the biggest differences. The rates are going to change. Another big difference that many people aren't expecting is the standard deduction is going to get reduced. So right now you'll see it's at $27,700. Well, in 2017 it was $12,700. So obviously these numbers here will be adjusted for inflation, so they'll be a little higher than what they are here. But you can see that's quite the difference from where it is currently at $27,700. Currently 90% of people take the standard deduction. When 2017 comes around, not as many people are going to be able to have as much standard deduction up front. Now understand you're going to have more of a chance to itemize when that time comes, so make sure you're planning for that. Personal exemption, things like that will come back and be more advantageous for you, but it is still going to be very hard to get $27,700 of tax-free income up front if you're married filing jointly, or $13,850 if you're single. So understand, not only is the first amount of money not as much tax-free, but we're also paying it at higher rates, which is going to force us to pay more in taxes. And we've actually done an analysis to show, and we've got another video here that you can check out to show how much of an impact this is going to be. A lot of people are going to see a 20 to 25% increase to the amount of taxes they're going to have to pay. If you're going to have to pay $10,000, well now you may have to pay $12,000. And so that's going to be a significant difference there. That $2,000, hey, if we can save that by doing stuff now, is going to put us in a better position. So here's our currently what we know is going to happen in 2026. We know tax rates are going up. I always ask people, do you think tax rates are going up or down? If you think they're going down, I'm wondering where you're living. Are you living under a rock or what's going on there, right? So we already know they're going up in 2026. The question becomes, what are they going to be after 2026? So let's just use history to kind of show what is the highest tax rates ever been? What have they typically done with tax rates to give us a feel of what we think they're going to do in the future. So right now, our highest bracket is 37%, as you can see on this chart. As you can see in 2017, the highest bracket was 39.6%. When I asked a question of what the highest bracket was of all time, most people have no idea that it was 94%. Right after World War II, the highest tax bracket was 94%. Ronald Reagan was actually a filmmaker back then. He'd make 2 movies a year, and that's it. Because what else money is there to make, right? He only gets $6 on every extra dollar he makes, and plus he's in California paying excessive state taxes as well. There's probably not much opportunity. There's probably not, much. He probably doesn't want to do that, right? And so that's what we're looking at there. So I've got a chart here to actually show you the history of tax rates. So 94%, like I just showed you, is right there. And then it's actually a 90% for quite a bit here for this decade. And then you'll see right now where we are today, right? And so right now today, we really haven't seen lower tax rates except for a couple other times. And if you remember in the 80s, tax rates were 70%. So I know a lot of you remember those times, and you can see that, hey, we were paying a lot more in taxes over time than we are now. And that's why I always say that taxes are on sale. And so my question is okay, we know they're going up in 2026, but what are tax rates going to do in 10 years? Especially when baby boomers are all turning the age of RMD time, right? Required minimum distributions. All of the baby boomers are now going to be required to take out money from tax-deferred investments, which that's where a lot of our wealth is currently. There's a lot of revenue that the IRS could go to that to get a bunch of money for taxes. And so what are they going to make tax rates at that time? When all these baby boomers are collecting Social Security and having to pay taxes on it, when they're having to take out money, they're required to take out money from their investments. Well, they can make the tax rates whatever they want, right? So that's my worry, is that they're going to increase tax rates to get extra revenue to cover our big debt crisis right now. Our country's in $32 trillion of debt. In order to lower debt, we've got to raise revenues. That's probably what's going to happen, right? So that's my expectation. You can decide for yourself. But I'm typically planning now, what we do for our clients is we plan now for the lower tax rates to take advantage of it so we don't have to pay higher tax rates in the future. So hopefully this helps you here. Hopefully it was educational. Go ahead and like this video if you enjoyed it. And we've got many other videos on topics like this as well. So go ahead and subscribe, and we'll keep them coming there.